there's an inflection point happening in quantum computing. The number of logical qubits are starting to grow. Well, just like Moore's Law would, I could totally expect 10 times more logical qubits every 5 years, 100 times more logical qubits every 10 years. Those logical qubits would become better error-corrected, more robust, higher performance, more resilient, and of course, will continue to be scalable.
Talking about developing new materials, Jim, at the molecular level, perhaps down the road. They do have this partnership with Novo on drug discovery.
Look, I've been waiting for that. Recursion was supposed to be 1, 2, and the drug person is excellent. I keep hoping that they do some big deals on cancer. You're able. I've been listening to a lot of people who claim they have AI, and it's starting to bother me again because they're doing spreadsheets and calling it AI. After working with all of the sites that are now saying they're really good at math, they're awful at math. What bank would let them in? But you're seeing, I mean, I did a piece last night that basically said, okay, here we go. IONQ, D-Wave Quantum, Rigetti, quantum computing, go get them. And David, look at that. I'm not saying I'm a sage.
No.
I am saying that Jensen is giving the green light to a lot of companies that may mean absolutely nothing, but they have quantum in their name. I mean, Honeywell has been very honest and said, listen, we're not ready.
Right.
And IBM does have quantum, and that's one of the reasons why IBM is at an all-time high.
Those are incredible moves. If you were lucky enough to have decided that quantum was where you wanted to be at the beginning of this year, you are very happy, or even last year.
Well, what do you mean
Guys,
by that?
Well, I mean, I think it's not yet proven, right? We don't know.
But it's younger people who are really cashing in.
And you've made
sit here and tell people to buy Smucker.
You've made this point, right? You've made this point about nuclear and certain crypto assets.
Well, it's very disheartening. I'm disheartened by it.
Well, don't be disheartened.
Why?
Following NVIDIA CEO Jensen Huang's optimistic remarks regarding the technology during the chipmaker's GTC Paris Developer Conference, stocks of quantum computing jumped in early trade on Wednesday. On Wednesday morning, quantum computing increased by over 32%. IonQ increased 7%, and Rigetti Computing rose more than 17%. The businesses produce software and hardware for quantum computing. The S&P 500 was trading flat in contrast. Huang told an audience on Wednesday that in the upcoming years, we would be able to use quantum computers to solve some fascinating problems. According to him, quantum computing is at a turning point. In contrast to the tech CEO's previous statements regarding the technology, investors saw the comments as optimistic about the timing. In January, Huang sent quantum stocks plunging after telling Wall Street analysts that highly usable quantum computers were probably 20 years away. Later on, the NVIDIA CEO retracted such remarks. Huang's remarks were made the day after IBM announced that it was constructing the first large-scale, error-free quantum computer in history, which is expected to be ready for use by 2029. At the moment, quantum computers are prone to mistakes. Both artificial intelligence, AI, and conventional computers are classical computers that use linear algebra, but quantum computers use quantum mechanics and sophisticated mathematics, which enable much greater processing power and make them more effective at resolving specific issues in domains like chemistry, cybersecurity, and cryptography. However, the industry's efforts to build practical quantum computers have been hampered by the computer's fragility and error proneness. In an interview, analysts said that IBM's announcement was a significant step in that direction. Large tech firms like Microsoft, Amazon, and Google have also been making headway in their own quantum initiatives. In February, Microsoft and Amazon revealed 2 quantum CPUs. In December, Google unveiled Willow, a quantum computing chip that it claims paves the way for a practical, large-scale quantum computer. NVIDIA, a manufacturer of AI chips, has also sought to gain market share. Shortly after announcing that it would construct a quantum research facility in Boston, NVIDIA held its inaugural Quantum Day in March 2025. Following NVIDIA CEO Jensen Huang's statement that the industry is nearing a pivotal stage in its development, equities with a focus on quantum technology surged in early trade on Wednesday. Huang stated at the GTC conference in Paris that quantum computing is approaching a turning point, pointing to increasing advancements in the technology's applicability to practical issues. According to a press statement issued on Wednesday, he also emphasized NVIDIA's CUDA-Q platform, a quantum computing service designed to facilitate future industry expansion. According to Huang, quantum systems, which use qubits instead of conventional bits to process data, may soon be able to address significant problems in a variety of industries. Huang's remarks indicate a change in tone. He stated in January that real-world applications of quantum computing would not be possible for decades. However, he changed his prediction in March at NVIDIA's inaugural Quantum Day, indicating quicker advancement than anticipated. NVIDIA announced earlier this week that it has teamed up with AstraZeneca, Amazon Web Services, and IonQ to create a quantum-enhanced computational chemistry workflow. So, what implications does this have for NVIDIA's stock? Let's explore that. But first, a big thank you to those of you who've stuck with us this far. Creating these videos takes significant effort and dedication, so if you're enjoying the content, please hit the like button, subscribe to our channel, and share your thoughts on NVIDIA stock in the comments. Your support truly helps us grow. Now, let's get back to the video.
All that sticks out to me here is a couple things. Supercomputer, that can't be bad. Europe's been spending a bunch of money, that can't be bad. But then there's this company they're partnering with, NVIDIA. Is there a better company right now to be partnering with? What do you make of this?
Yeah, I mean, I think it's an excellent position for HP to be in right now, especially considering some of the moves they're making within their internal business. To your point, though, they're partnering with NVIDIA. They're going into Europe, which has this potential for a big AI offering in the future, a lot of market share there. Partnering with Germany's supercomputing center to build a new supercomputer. At the conference in Hamburg, Germany, the company said that Blue Lion, which is going to be the name of that supercomputer, will be available to scientists in early 2027 using NVIDIA's Vera Rubin chips. We know that those chips are taking off. They're kind of the successor to that Blackwell lineup. They've also got the Vera CPU, which is now their first custom CPU that's going to be built with those GPUs. And this investment for NVIDIA has made a lot of sense as well. You know, they've been trying to push more into Europe. They've got Jupiter, which is another supercomputer that's used at a German research institute. That's officially become Europe's fastest system. As we look at some of the impacts for HPE, they've been struggling a little bit. They've slumped this year due to some disappointing financial results, the broader market weakness that they've seen. They recently reported an earnings beat on revenue and earnings per share. But they tightened their outlook a little bit. Part of that was seeing some better visibility in the conditions and some stabilizing demand. The good news is their AI system, the orders we've seen in AI has really helped boost that revenue for HPE. So news like this is certainly welcome for investors.
Yeah, it looks like it's going to be, at least if the plans go through, built in Germany at that supercomputing center. But when you look at how the stocks reacted, I know it had a nice move kind of post-earnings, but it wasn't able to hold on to all of those moves or that move intraday. It's been in kind of a tight but steady uptrend going back to the lows of early April. When you look at this performance, you look at sort of the lack of oomph around this headline, is it concerning that HPE doesn't, perform just a little bit better when they have the good news? Is there the overall struggles that are still plaguing the company? Are they still so loud that investors are having trouble overlooking them?
That's a great way to put it. They are loud enough right now to really push out the noise of whatever sort of future profits these endeavors may see. Right now, if we look at this last earnings report, server revenue, which was, their greatest source of revenue, up 6%, about $4.1 billion. That beat expectations. But if we look at the operating profit side of things, those profit margins just came in at 5.9%. That's down from 11% last year. Now, the company expects that their server business is going to hit 10% operating margin by the end of the fourth quarter. However, we're seeing some financial service revenue slip. Hybrid cloud is up. Intelligent edge is up. On the outlook side, again, we saw them tighten that up a little bit as they're able to kind of visualize what the marketplace is going to be like. But they did lower their top-end sales outlook full year, and they now expect just a 7 to 9% revenue growth. Previously, they were looking for 7 to 11%. We also know they're in the middle of a cost-cutting issue where they're trying to, really try to cut costs, including jobs. They also have the Juniper acquisition, which is awaiting a court decision. We're likely going to see that kick off next month, and I think investors are well aware of those situations. They're not yet ready to put the pedal to the metal on these future, these future propositions that they're seeing with news stories like this.
And with that said, I start thinking about names that I kind of put in this bucket, and there's differences between them, but whether it's an IBM or a Dell or a Cisco or even a Microsoft, you start looking at them on a relative basis, and it just doesn't look like, whether it's institutional investors or retail investors, that they trust HP enough to move capital out of those other names. I mean, what, 3 of those 4 got to be near all-time highs, whether it's, Cisco, whether it's IBM, whether it's Microsoft. They're just outperforming so dramatically. What do you make of that?
Yeah, I think you're right. I mean, I think it's a very tough and a very competitive atmosphere right now, and we've got HP, which is trying. They're certainly making a lot of moves. I think the cost-cutting measures could go a long way. Certainly what we're seeing in terms of them trying to innovate, partner up with a name like NVIDIA and continue to deepen that partnership is no doubt about it a good step in the right direction. That said, very competitive marketplace. You've got big names like you mentioned out there that are making very good moves as well. And it's tough for investors to decide to switch over and put a lot more money behind, Hewlett Packard whenever it's got these other names that they can focus on that might be seeing better returns right now.
Yeah, I guess how I would look at it too, I think the cost cutting is prudent, and there's certainly, reason for value in some of these names perhaps. But when a company like Microsoft can just keep spending in a time where it seems like spending is critical in this AI race, you can understand why investors may be.
Wells Fargo claims that a significant portion of the performance improvements in recently listed supercomputers are being driven by NVIDIA's Gracehopper CPUs. Out of the 48 new systems added to the list, 5 Gracehopper systems accounted for almost half of the computing performance. According to the analysts, AMD GPUs are now found in 7 of those computers, while NVIDIA GPUs power 27 of them. However, with the support of its El Capitan system, AMD continued to hold the lead in terms of total GPU cores. In comparison to the June 2024 list, the business included 11 more systems that used its EPYC CPUs, increasing the total to 173. AI accelerator use is increasing, as evidenced by the June 2025 list, which reveals that 234 systems are currently employing them, up from 210 in November. AMD GPU deployments increased to 26 from 14, while NVIDIA GPUs were utilized in 201 systems, up from 172 a year before. In the meantime, Intel's GPU core share outside of China decreased, from 15% in the prior list and 20% the year before to 13% now. Additionally, NVIDIA's Grace CPUs gained popularity and are currently found in 13 systems with more than 3.6 million cores. In the short to medium term, NVIDIA, the industry leader in artificial intelligence, AI, chips, and related technologies, is ready to step up its acquisition activity. NVIDIA has demonstrated great astuteness in its previous acquisitions. Notably, it has been a major success with its largest acquisition to date, the $6.9 billion acquisition of high-performance networking expert Mellanox Technologies in 2020. Investors should therefore be able to rely on future acquisitions to be astute and contribute to increasing NVIDIA's earnings growth and, consequently, its stock price. CFO Colette Kress's remarks from last December and my recurring examinations of NVIDIA's employment postings, which indicate the business is strengthening its mergers and acquisitions, M&A skills, are the 2 primary factors that led me to make my prediction. Furthermore, the corporation has a lot of money, so it only seems reasonable that it will increase its purchase activity. Although interest income is being generated, there should be more useful uses for some of that money. Furthermore, NVIDIA's board of directors and upper management are aware that strategic acquisitions can contribute to increased profits, which in turn should raise the company's stock price. And since all of these people have significant to enormous wealth linked to NVIDIA stock, they undoubtedly want the stock's positive trends to continue. To stay informed about the latest developments from NVIDIA and the ever-changing stock market, consider subscribing to our investing tutorial channel. We provide daily updates on significant market shifts and key catalysts, so hit that subscribe button to ensure you never miss crucial information. We'd love to hear your thoughts on NVIDIA stock, so please share your opinions in the comments below. Now let's dive into today's video.
To get Harton, read Sam Altman's blog post from last night. It's entitled The Gentle Singularity. And we had Jensen. I think when you talk about the leaders right now in terms of where the future is, it's Jensen, and it's a lot of it's Sam Altman.
Well, they're great friends. And you remember, nothing took off.
I took out a few things
until
that
he gave Sam
I took out a few things that just struck me in what is
tell me something
in
good.
What is a letter that I think people should read because it's got a lot of different things in it. But part of it is, of course, talking about the near-term advances that are coming. As for the 2030s, for example, he writes, intelligence and energy, ideas, and the ability to make ideas happen are going to become wildly abundant. We hear that word a lot, by the way, abundant. These two have been the fundamental limiters on human progress for a long time. With abundant intelligence and energy and good governance, we can theoretically have anything else. He goes on to say, if we have to make the first million humanoid robots the old-fashioned way, but then they can operate the entire supply chain, digging and refining minerals, driving trucks, running factories to build more robots, which can then build more chip fabrication facilities, data centers, and the rate of progress will be quite different. And finally, last part I'll take for you guys, and the one I've been focused on, there will be very hard parts, like whole classes of jobs going away. But on the other hand, the world will be getting so much richer so quickly that we'll be able to seriously entertain new policy ideas we never could before. We probably won't adopt a new social contract all at once, but when we look back in a few decades, the gradual changes will have amounted to something big.
Well, okay.
Because nobody's going to have a job, so we're all going to be wandering around looking for some purpose. But we're going to have an age of abundance. An age of abundance.
You drive me crazy.
Thank you.
We have
succeeded.
A birth rate.
My work here is done.
We have a birth rate that's like the Handmaid's Tale, and we need people. And you may think that and we're rounding up people in this country and sending them where God knows where. We don't let anybody in the country. We have a series of jobs now that the only people who really wanted them were people who felt, look, this is how I can get my kid to college, which is really kind of the goal. And you're going to need all the robots you can get, and you need robots making the robots. And I don't know why you are so cavalier about the idea that we have enough people in this country to do jobs.
I'm not talking about the population at this point in terms of the lack of growth in certain countries. Obviously, our country is far from in danger. South Korea, they got a real problem. That's something like
Italy has a problem.
In Italy, yeah. But all that said, I just want to point out that you're going to continue to hear, whether it's Musk or Altman or Hassabis at DeepMind, this idea of an age of abundance coupled with huge social changes that may have to take place in the social safety net, perhaps,
revolution.
Or a universal income. It's coming fast, Carl.
How about those
potentially? Now, I always sit here and remember we talked about autonomous cars 7 years ago, like they'd be here tomorrow, and they're finally just about to
and they're about to fly too. I mean, Joby just got a lot of money from the government.
They're not always right.
Joby's real. I got to tell you, Carl, David probably in another time sat here and bemoaned the seamstresses.
Or the farmers.
He misses the agrarian economies.
He misses the Jeffersonian period, David.
The man brought us tomatoes, all right? So, enough.
With only $8.5 billion in long-term debt and over $52.7 billion in cash and cash equivalents, NVIDIA has a strong financial sheet. Additionally, the business produces a significant amount of free cash flow, FCF. It has produced around $72 billion in free cash flow over the last 4 reported quarters, with over $26 billion generated in the most recent quarter. NVIDIA outperforms 3 of its main rivals, Advanced Micro Devices, Intel, and Broadcom, in terms of both balance sheet and free cash flow generation. NVIDIA benefits from this in a number of ways, particularly when it comes to acquisitions. Despite having a far smaller cash position than NVIDIA, AMD has a strong balance sheet. In addition to having a significant amount of long-term debt in comparison to its cash position, Intel is also spending money rapidly, as seen by its negative free cash flow, FCF. Despite having a substantial long-term debt load in comparison to its cash position, Broadcom uses a sizable amount of cash to pay off its debt, despite producing solid cash flows given its size. How do these businesses oppose NVIDIA? Discrete graphics processing units are also produced by AMD and Intel for use in data centers handling AI tasks. According to industry research firm IoT Analytics, NVIDIA has a 92% market share in 2024. Additionally, AMD and NVIDIA are rivals in the gaming GPU market. NVIDIA and Broadcom are rivals in the data center networking market. Additionally, it produces custom chips known as application-specific integrated circuits for a number of hyperscalers. These chips are being utilized in place of GPUs for specific use cases. To put it briefly, NVIDIA appears ready to step up its acquisition activity in order to support its steady growth. The business has demonstrated a high level of acquisition expertise, and there is no reason to doubt that its impressive track record will continue. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve.
It's time now for today's strategy session. Analysts across Wall Street are turning bullish on U.S. stocks, multiple strategists boosting their year-end 2025 targets on the S&P 500 after stocks recovered from their tariff-induced sell-off. Joining us now, we've got one of the strategists boosting his target, Keith Lerner, Truist Co-Chief Investment Officer and Chief Market Strategist, and good friend of the show. Keith, good to see you here. Just take us into the thesis behind why you're now raising your target as well.
Yeah, well, great to be with you all. Maybe I'll take a step back for some context. Back in February, we were around all-time highs. We downgraded equities. And then as towards the lows, we would tell our clients to rebalance, that you should start thinking about upside risk. On the initial rebound, when we had the rebound, we actually modestly took some off the table. In hindsight, somewhat prematurely. But at that time, our work was suggesting that recession risk was still relatively high. After that, China kind of walked back. So now, as we kind of reset and say, okay, where are we at now? In the weight of the evidence in our work suggests at least more of a neutral posture overall. And as we look at things, one, the rebound off of this low is actually a positive sign when you look off 6 months later. Instead of recession, being say 50%, I think our base case is more of a muddle through. And when something that's changed since February when we first downgraded stocks was earnings. Forward earning estimates for the S&P back in February were starting to move down. That's part of the reason why we downgraded stocks. Now they have inflected higher. A lot of that is being driven by tech and communications, and that's the final point. We had all this tariff uncertainty, right? The big T was tariffs. I think what the market has found over the last few months is the other T, technology and AI, which has been the dominant theme of this bull market, is back in the forefront.
Yeah, Keith, really excited to get your thoughts on the tech sector specifically, which, as you mentioned, you did upgrade as part of this. To what degree do we continue to learn the lesson from investors that you can rest on your laurels of the Mag 7 stocks, those big tech stocks, regardless of the broader market activity? And how bullish does that make you?
Sure. Well, the first thing I will say, we've been overweight communication services, which is kind of also an AI play all year long. We added to tech. And I think what's also important with tech, I know a lot of times we're looking at how much we've moved from the lows for the market and tech. But if you look at the S&P technology sector since last July, we're flat. And you spoke about NVIDIA earlier. That's also only up modestly since last July as well. So if you look at the big picture for the overall market, the S&P, we're flat for 7 months. For the technology sector, flat for almost a year. So I think as we test these kind of technical levels, and I think eventually we will break above that, there's probably some pain trade. That said, I just want to be clear too. I mean, we are starting with higher valuations for the overall market. So I think there could be a squeeze higher, but I don't know that we're off to the races. I certainly expect that there'll be some bumps along the way, especially in the summer where we see some illiquidity along the way. But I think in general, the underlying trend is still positive, and we want to stick with that underlying trend.
Okay, you started to answer my question, which was around valuation. So I'll tap more into that illiquidity. Does that mean low volume during the summer means more volatility in this interim period of time?
Well, I think what can happen is, well, I'm hoping for the summer doldrums, right? After what we've seen in the first half, like some boring trade would be actually probably good. But I think what can happen is if you get some unexpected headlines, a lot of people are on vacation, there's less liquidity, that I think you can see moves exacerbated as well. And, there's an old saying, sell in May and go away, but that's actually incorrect. What happens really, the market tends to do well until July, and then that's when you start to see more seasonal weakness as you get into, August and September. So I think that's something to be kind of on lookout for. And again, for the economy, we're expecting more of a muddle through. So this isn't to our view like, hey, this is time to be on all offense. But again, I think for investors and even people watching the show today, I think we'd be more aligned with long-term target, equity allocations. Again, not overly, on offense or defense, but the underlying trend, again, I think we have to respect it.
Right? Don't fight the tape, it sounds like, is what you're saying, Keith. But I wonder to what extent you feel that investors are somewhat post-tariff and instead focused on the moves of the Federal Reserve, especially given that we are seeing such a strong market reaction to that cooler than expected inflation print this morning. Does today's market action show that the market is moving from being Trump-driven to Fed-driven?
I would almost say neither. I mean, they're both important, but I think the way I think about it is for some period of time, tariffs were the only thing that mattered. And I think we're finding out today a lot of other factors matter. So tariffs still matter, just not the same degree. The Fed still matters, but not the same degree. And I think the thing with the Fed right now, the reason why I say it matters, but it's, even if you look at the Fed funds futures or what the market is pricing in, the first rate cut is September. So think about where we are today. We're still in June. There's a lot of time between now and September where the Fed really comes back into play in a meaningful way. I think this is the step in the right direction, showing CPI coming down. I think there's still some lingering questions. Are we going to see some changes in the inflation data as some of the tariff impact comes in? I think that's an open question as well. So in the interim, I do think, I do think the economic data matters a lot, meaning there was a lot of concern about recession earlier on. Are we going to see some air pockets over the next couple months? Is going to still show some resiliency. So like things like the weekly jobless claims are going to be important. The employment picture is going to be important. The inflation trends and the Fed. So again, I think all these things matter, but I don't think it's as just specific. Like this is the main thing the market is now focusing on. And again, going back broader picture, back to the conversation, tech matters and what happens on the technical side as well.
Keith, just briefly while we have you here, it seems that a lot of firms and institutions are trying to measure what the base level of effective tariffs end the year near, and what that also looks like for Chinese goods as well within that broader picture. 15% is what one firm that I cited earlier in the show is tracking towards, and then the level of Chinese goods higher at 30 to 40%, their estimation. How are you at Truist modeling that?
Yeah, I don't listen. I think this isn't precise. There's a lot of moving parts. There's the sector tariffs on top of the universal tariffs. So I think the baseline for a lot of countries will be 10% higher on China, some sector tariffs on top of that. And again, these negotiations, as Greg Valliere just talked about earlier, who is going to take time. I mean, this doesn't happen overnight. But I think from the market's perspective, if that is the baseline, and the market can likely adjust, they understand it. If it becomes where we have some tougher negotiations, and you may have some of that causes that volatility in the summer later on, I think that will scare the market. But at this point right now, where they are today, I think the market is comfortable that companies can adjust. But it's still an open question where we end up, say a year from now or 2 years from now, because we're really just beginning this longer term process.